Instead of guest speakers this month, we have three of our very own dealers from our Asia Pacific and US markets desk to share with us their findings and knowledge. So without further ado, please allow me to introduce our first speaker of tonight, Chester from our US markets team. Chester, please.
Hey, okay, yes, thank you, Darren. Right, good evening, everyone. Thank you for taking the time to join us in this month's webinar. My name is Chester. I'm from the corporate sales team who specializes in the US markets. Together with me, we also have Zihan and Ying who will also be speaking in the later parts of the webinar as well. Right, the flow of today's content will be a simple discussion of Chinese companies that are being listed in the US markets. In short, we call them ADRs. We will be exploring the happenings of them in the recent months, and after which, we will also be looking at how their stock prices have been moving during this time period. My colleague Zihan will then be talking on Asia markets, so do stay tuned for that. You guys will also be expecting some live counter review with technical analysis, and finally closing off with some Q&A. At any point in time, do feel free to post your questions in the Q&A section. We will do our best to address them at the end of this webinar. All right, so yeah, without further ado, let's start off this webinar. Okay, before we jump right into the main topic of Chinese ADRs, I believe that it would actually be good for us to first have a rough idea of what ADRs are. Okay, so what is an ADR? Before we answer that, I'm pretty sure that in some point of your investing journey, you might have wondered, how does a foreign company list their shares in the US stock market? An ADR would be an answer to that question. So the term ADR actually just stands for American Depository Receipt. This so-called receipt is treated as a negotiable certificate issued by a depository bank, which represents the number of shares. In most cases, it is usually just one share of the foreign company's stock. The ADRs will then be trading on the US stock market just like any typical domestic share. Now, with that in mind, ADRs actually do, as a result, give US investors the opportunity to invest in overseas companies that would otherwise be not available. It can also be a win-win situation for foreign firms as well. But that's because these foreign firms are now able to attract American investors and capital without the trouble and expense of listing on the US exchange directly. So how does an ADR work? A US depository bank must first purchase the shares that are listed on its domestic exchange. The bank then holds these shares as inventory and issue an ADR for domestic trading. ADRs are typically being listed on the New York Stock Exchange, NYSE, or the NASDAQ. Right, so the price of the ADR may represent the underlying shares on a one-for-one basis, a fraction of a share, or even multiple shares of the underlying company. So to give you some perspective, basically, right, it's in a ratio aspect. And we have these three following counters here, BABA, JD, and Baidu. They are the more known ADRs in the market. So we can see, like, for example, BABA, one receipt actually represents for 8 shares in the Hong Kong market, and so forth. Okay, so this ratio, right, is actually based on the depository bank's discretion. They will try to set it to a level that can provide the most appeal for investors. The prices are also being closely tracked with companies' stock on its home exchange. But this is to promote price efficiency and also at the same time to try to prevent arbitraging between both markets. And also there also seems to be a trend with the ADRs trading at a slight premium as compared to their underlying shares. But it could be because of the advantages that ADRs have, which as a result, this increases the demand on the ADRs. Yeah, not to worry, right? We will be discussing on the advantages of ADRs in the next slide. Okay, so the advantages, like why do we want ADRs? Okay, so not taking into account the back-end process by the depository banks, most investors can just simply take trading of ADRs like trading regular domestic stocks. Yeah, it is that seamless, and not to mention, it is fairly easy to access and trade. This also eliminates the need for investors to go through foreign channels just to purchase foreign shares. And since the shares are now available domestically in US, the value of the shares are also denominated in USD. So this immediately allows traders to avoid the risk related to currency rates fluctuation. And ADRs are especially beneficial for US investors who are looking to diversify with foreign shareholdings. That's because they might not have access to Hong Kong or China markets. And also just a fun fact for you guys, Singapore on the other hand actually might have better access to these Chinese markets. And for last advantage out of the many, ADRs also allow for traders and investors to further diversify their portfolio towards international markets. And also for some of these new investors, in case you are thinking of where you could purchase these ADRs, then not to worry. With us here at Phillip, a majority of ADRs are made available for trading. And well, of course, there will always be risk involved when it comes to ADRs. So the first risk I would like to mention would actually be political risk. So any changes in politics or regime in the issuing company's country could potentially undermine exchange rates or even destabilize the company and its earnings. Right? The second risk would be inflation risk. Rising inflation in the issuing company will erode the value of the currency. And lastly, there is also a regulatory risk. Companies might face delisting due to non-compliance. And not to worry, this topic about delisting due to non-compliance will be discussed in the later parts of this webinar. And yes, on a side note, apart from ADRs, there is also another type of receipt known as GDRs. It simply just stands for Global Depository Receipt. It works exactly the same as ADRs. The only difference is that ADRs only list foreign shares on the US markets, while GDRs are meant for foreign shares to be listed on any foreign exchange apart from their domestic exchange. All right, now that we have a better understanding of ADRs, let's discuss more on the Chinese ADRs that are on the US markets. If you guys have been monitoring the markets regularly, you might have noticed that there has been a lot of bearish movements coming from the Chinese companies, such as Alibaba, for example. Yeah, as we can see from this chart from TradingView, this particular EDF, right, it tracks the performance of Chinese equities. And from this, right, we can see a clear downtrend from the beginning of 2021 and hitting its lowest in 6 years since 2016. And so what is causing all this down move, right? So back in 2020, the regulators have passed an act known as the Holding Foreign Companies Accountable Act, or HFCAA for short. This act requires US-listed foreign companies to submit an audit that can be reviewed by a US committee. So if foreign companies are not able to comply with this requirement, they do stand a chance of being delisted from the US markets. So yeah, this actually seems like a fairly reasonable request to protect investors, isn't it? But this act has actually contradicted with one of Chinese laws that does not allow audit and accounting data to be taken offshore. And as a result, we are seeing this weak performance coming from Chinese ADRs. So in short, investors are fearful of any possible delisting due to non-compliance. Yeah, so with that in mind, I'm sure some of you might have been wondering, so does this mean that all Chinese ADRs will eventually be delisted? Well, I think we are still not sure on how this whole situation will unfold in the future. But it would be good to note that these Chinese lawmakers are working on an alternative with regards to their law about audit and accounting data. At the same time, US and China do meet time to time to discuss about their relationships. But one thing is for sure, and that's the fact that delisting due to non-compliance will only happen in 2024. However, do note that companies might also be thinking of voluntarily delisting if they feel that regulations are going to remain the same. Okay. In the meantime, let's take a look at how HFCAA has impacted the US markets. Okay, well, keeping in mind that all Chinese ADRs are at risk of delisting due to non-compliance, earlier in the month of March 2020, the SEC, or Securities and Exchange Commission, announced the first 5 companies that are at risk of being delisted, if they do not comply with the auditing rules by 2024. So these companies are ADR Research, Beijing, HUTCHMED, Yum China Holdings, and Zihan. Yeah, so share prices of these 5 counters, they fell for the day. Either a gap down could be observed or the trading day closed as a big bearish candle. However, it is good to note that these 5 counters were not actually being singled out by the SEC. They were being named simply because they were the first Chinese companies to have filed their 2021 annual reports. So, the list of possible delisting due to non-compliance could further increase if the current situation does not change. Right, so this delisting, I feel, should not be treated as unexpected because the SEC has already made things clear about the regulations. However, investors might have shifted their attention to pressing matters such as the pandemic and geopolitical crisis. And as a result, fears for Chinese ADRs were materialized when the news surrounding those 5 counters were made public. This in turn sent waves of fear into other Chinese equities that resulted in a sell-off. And yeah, speaking of this geopolitical crisis between Russia and Ukraine, it was a topic for one of our previous monthly webinars. If you guys have not watched it, right, yeah, do feel free to head over to our YouTube channel to check it out. So yeah, with all these fears of delisting, many Chinese companies are opting towards dual listing in their home exchange, or simply delisting in the US exchange and listing only in their home exchange. And not to worry, we will be talking about the Asia markets in the later part of the webinar. So do stay tuned for that. And also, yeah, to add on to trading on different exchanges, some investors might be thinking it might be troublesome for them to purchase foreign shares as they have to go through different channels to obtain these so-called foreign shares. However, with the advancement in technology, some brokers do allow trading in multiple exchanges in a single platform. And here in Phillip, yeah, we do have the function for our customers as well. Okay, moving on. Okay, I would like to next bring our attention towards the various funds tracking Chinese equities. So to take a look at this table below, it compares the fund's exposure to ADRs before and after the HFCAA has been passed. A clear theme can be observed from the funds highlighted in green, whereby these funds are reducing their their exposure to Chinese ADRs after the act has been passed. So you can see a big drop in their exposure. So some reasons why this exposure has changed. It could be due to the fact that because of the prices of all these Chinese ADRs, they have dropped in the recent years, and some passively managed funds have to rebalance their holdings in accordance to their mandate. Or another reason could be they might just be more comfortable owning their shares from their home exchange, in order to mitigate any risk involved with the delisting. However, by adjusting and reducing their exposure to Chinese ADRs, the liquidity in turn will surely be affected negatively. Some funds, on the other hand, such as the funds highlighted in blue, they have not made any changes to their exposure. Now, this is because they believe that changes will be made as the situation develops. All right. So through this scenario, we are able to note that there are different schools of thought when it comes to approaching the same situation. This goes the same for retail investors as well. Some might be looking to purchase shares at a cheaper price. Some might be thinking of selling their holdings. But whatever this decision, one thing is definitely guaranteed, and that is the increased volatility. Okay, next, I would like to draw your attention to the following 3 charts from TradingView that shows the performance of various funds that tracks Chinese equities. They are all from the time period of 2021 to current period. And if you see later, they do all share the same similarity, which is the fact that they are all in a downtrend. And also, to give a little perspective, we have also included a table which shows you guys the top 5 holdings of that particular fund. All right, so we have MCHI. You can see the constant downtrend. Next up, KWEB, also downtrend. And lastly, we have PGJ, another downtrend. So these 3 funds here are one of the more popular traded funds. And you can notice their weightages with the different companies. Yes, and so through this, right, we are able to observe the fear that is present in Chinese equities. So by now, we all know that the main cause of the sell-off could be attributed to the fact that Chinese companies are not complying with the HFCAA. So Chinese officials do recognize that fact as well, and has released a statement saying that they would continue to communicate with US regulators and strive to reach an agreement on the China-US audit situation. China is considering granting US authorities full access to company audits. Doing so will allow Chinese ADRs to continue trading publicly in the US. China has also proposed revising confidentiality rules involving offshore listings, thus removing the legal obstacle that is stopping cooperation between both countries. But they have also mentioned about good progress made in communications with the US. And at the same time, Chinese officials also have stated optimistically that through joint efforts of both parties, an arrangement can be made for cooperation that is in line with the 2 countries' legal and regulatory requirements. And they have also promised to keep markets stable. And so all this relatively positive news, it has managed to soothe overseas investors for the time being. And as a result, this has sparked a bounce in price for long-term lows for the Chinese equities. All right, now let's take a step back to think about those statements made by these Chinese officials. So to most investors, this news could come as a surprise to the market, this positive news. But that's because not many people would think that this is something that is even on China's mind right now. They're thinking that these Chinese governments would be more concerned about the current geopolitical tension and their ties with Russia. So as a result, the rally seen from Chinese equities could be considered as relatively stronger. Yeah, but even though not much action were taken, it is, however, viewed in a positive light. It shows that China has realized that something needs to be done in this situation as well. And the speed at which they responded to the sell-off would also suggest that China does not want things to get out of control. So how did the market reacted, from these few statements from the Chinese government, right? So yeah, allow me to draw your attention towards the chart from TradingView below. It shows the ETF MCHI again that tracks the Chinese equities. So yeah, this period of drawdown was what was mentioned previously, the whole HFCAA situation. And then this little bounce here was observed after the Chinese government came forth to reassure their investors regarding their fears. Yes, and if you are also thinking of buying into one of these Chinese ETFs, most of them are available for trading on Phillip. And buying into them is actually just one click away. All right, moving on. Okay, while it is true that China has begun to show support for firms listed overseas and that stock prices have rallied, it is also true that everything is still at a very premature level as of now. Some analysts do remain pessimistic on Chinese ADRs, stating that the road ahead is still filled with many uncertainties, despite having signs that Chinese ADRs are at lesser risk of being delisted. Many investors are now very happy with the progress, but they might not be focusing on the fact that there are still many uncertainties surrounding this situation. Instead, I feel that they might just be focusing on the short-term gains. And also do keep in mind that these Chinese ADRs are still very much in the reds, compared to the past. Yeah, and all these uncertainties actually could come from the fact that at the end of the day, many questions still lie ahead of us. Even nobody knows the exact specifics of how the auditing process will be. Will Chinese ADRs meet the requirement fully? Will China comply with the SEC? These are all questions that we still have not answered. And at the moment, not much action has been taken. Everything has just been discussion, so just verbal. But it will be ideal for investors when we do start seeing some form of physical action being taken around this whole situation. Yes, and lastly, I would like to mention, just like previously, about the different schools of thought. There will, never be a correct way in our whole investing journey. All investors simply have to understand the risk involved and do their own due diligence. Whether is it to purchase these Chinese ADRs at a bargain or to liquidate their holdings on a downtrending stock. There is simply no correct way in this whole situation. However, I would still like to mention that having exposure in foreign shares could help further diversify your portfolio. An ETF would also provide for good diversification if investors do not want a single stock exposure. So yeah, when selecting these which ETF that you might want to purchase, we would usually suggest for investors to actually do some research on the underlying holdings of that particular ETF to see which has a better fit for their portfolio. And Phillip might just be the platform for your trading and investing needs. We look forward to accompany you as you navigate through these volatile times of the market. All right, yeah, so I've come to the end of my portion for today's webinar, and thank you for your attention so far. I'll pass the time back to Gavin to be talking about some promotions that we might be running. Thank you.
Thank you, Chester. And now for a short break between the presentations. So for those among our audience who have invited your friends or your relatives to this webinar, firstly, we'd like to thank you for doing that. Secondly, we'd like to give you some value back. If you have a friend who isn't our client and they open an account with us through your referral, you can get $88 cash credit, up to 10 people referred. So one Poems account holder, you can refer up to 10 people. The total potential of value you can get is up to $880. Now, for those who have had Poems recommended to you and you're thinking, well, what do you get out of it apart from all the services and the amazing things that we already have? Once you have deposited a minimum of $3,000 into your account, which is a fairly reasonable amount, you get 2,000 Poems rewards points. Now that's about $40 worth of Shopee vouchers. And in addition to that, you get free unlimited US trades for 1 month. So you can check out the link in the chat. I'm just going to send it right now. That's the link to our landing page, or you can scan the QR code on the screen as well. So remember, one person, one Poems account holder, you can recommend up to 10 friends, relatives, family, and get up to $880 of cash credit. Scan the QR code, or you can just click the link in the chat. So now, after that short break, we've come to the end of the promotional part. And now I would like to hand over our time to our second speaker for tonight. Please join me in welcoming Zihan from our Asian Markets Dealing team. Zihan, please.
Thank you, Darren, and thank you, Chester, for the informative sharing. So as you can see from the chart here, Chinese ADRs suffered their worst performance in the first quarter since 2008. mainly driven by fears of potential delisting in US market. There are approximately 250 Chinese companies listed in American exchanges with a combined market cap of more than $1 trillion at risk of getting delisted. Global investors seem to pull money out of China on a huge scale as well. A net outflow of 59 billion Chinese yuan through the Northbound Stock Connect program with Hong Kong. Looking at the timing of the capital outflows, it was after Russia's invasion of Ukraine. The delisting threat is further adding to the general investor anxiety over the border geopolitical tensions. So all these uncertainties cause some of the foreign capital opt for an exit from China market for the time being. As all we know, there is a strong correlation among Shanghai, Shenzhen, and Hang Seng Index. All three indices performed quite badly due to the mounting concerns over geopolitical tensions, massive COVID lockdown in China, and the tech regulative crackdown imposed by Chinese policymakers since last year. Delisting becomes another contributing factor that dragging down the market sentiment. But looking at it from a broader perspective, the moves by the US regulators on ADRs could also be interpreted as a political move. Regardless of the real motive behind the act, as investors ourselves, we need to be aware of the options that those US listed Chinese companies have when they are down the road to delisting. So I have listed out the most probable 4 options that those US listed Chinese companies have at the moment. The first one definitely will be the companies to comply with audit regulations and stay listed in US. Alternatively, they can look for the alternative listing venues such as Hong Kong or mainland China. Companies also can go with a voluntary privatization. The 4th option would be company shares be traded in OTC market, but in this case, the liquidity will be a major issue. The shares likely to be sold at discounts. So let me bring you through some of the top stock exchanges in terms of market capitalizations as of December 2021. As you can see from the chart here, New York Stock Exchange and the Nasdaq are still the most attractive listing venue in the world in terms of their liquidities, trading volumes, fundraising opportunities, as well as the well-established regulatory framework. Shanghai ranked number 3 and Hong Kong ranked number 7. So while Chinese companies do have a number of choice for their IPO or dual listing locations, Hong Kong Stock Exchange and the China Mainland Exchange stand out as the most attractive destination for Chinese companies and investors for several key factors listed here. In this table, the darker the green dot is, the more attractive and favorable for the companies to get listed in the respective exchange. By doing this apple-to-apple comparison, Hong Kong Stock Exchange seems to be a more reliable and sustainable fundraising platform for those Chinese companies as compared to Shanghai and Shenzhen. Here are some of the reasons. Firstly, listing prerequisite in mainland China is very stringent. Historical reason is that the government authority will give long-standing and state-owned companies the priorities for fundraising in mainland China instead of innovative tech companies which their profitabilities are consistently being delayed. Meanwhile, modern shareholding structures such as variable interest entity, in short form called VIE structure, is still not very accepting by the Chinese authorities, making it harder for the companies to go listing in Asia. But in Hong Kong Stock Exchange seems to be a more natural Asian venue for homecoming listings. By listing in Hong Kong, companies are able to retain access to global investors while being more palatable to Beijing. Another plus point is that Hong Kong Stock Exchange investors base typically has a strong familiarity and understanding of Chinese markets, businesses, as well as culture. A market-driven environment with limited government intervention also encourages more companies to consider listing in Hong Kong. As mentioned by Chester earlier, Hong Kong Stock Exchange and the China security regulators also start discussion over listing reforms, potentially creating more effective and efficient fundraising opportunities for those Chinese companies homecoming. So by means of homecoming, the two most popular ways of listing have been identified and shown in the table here, which are secondary listing and dual primary listing. Secondary listing means ADR holders can swap ADRs into Hong Kong listed shares at a set ratio. Meanwhile, secondary listing allows companies to enjoy more exemptions and preferential terms, a lower listing cost, and a faster timeline. For companies apply for dual primary listings, they have to fulfill various stringent regulatory listing requirements for both listing locations, which is more complex, time-consuming process. Shares will be issued independently in two listing venues, and they are not convertible. However, dual primary listing is one prerequisite for inclusion in mainland Hong Kong Stock Connect, while allows companies to widen their investor base. So far, companies with secondary listings are excluded from this Stock Connect. The increase in number of Chinese companies with secondary listings in Hong Kong is quite noticeable in recent years. This indeed gives investors an alternative for stock investments. US listed firms including Alibaba, JD.com have already floated in Hong Kong. In fact, the portion of Hong Kong listed shares at least two companies almost doubled last year, as shown in this chart here. Besides those big tech giants, here is another consolidated list for US primary listed Chinese companies with Hong Kong secondary listings for your reference. Moving on, for this table here, showing the global fund managers are reducing their holdings in US listed Chinese companies and switching to the shares of companies listed in Hong Kong. Large funds such as Temasek and Matthews Asia have shifted holdings of Alibaba ADRs away from New York Stock Exchange as early as 2020. For this slide, may need a bit more attention from you. Those are the top 20 most actively traded Chinese companies listed in US only. Some of them, including Pinduoduo, Bilibili, VIP Shop, and Tencent Music, are eligible for Hong Kong secondary listing, and some may opt for dual primary listing instead. Investors may follow up with some of the company news lately to see what listing destinations they are heading to. So it's still unclear if the agreement on joint auditing between US and China can be reached. Regardless of regulatory outcome, the geopoliticals would be a strong drive to speed up US listed firms' shift to Hong Kong. And Hong Kong still has an edge in attracting Chinese unicorns despite the heightened geopolitical risk. To accommodate this shift, Hong Kong Stock Exchange eased the listing requirements since beginning of this year for Greater China companies and lowered the minimum market capitalization threshold to 3 billion Hong Kong dollars. If a joint auditing agreement is reached, Hong Kong share trading may stay less active than ADRs, but ultimately will be a good news for global investors. If the audit negotiation fails, Hong Kong Stock Exchange turnover could possibly double if all trading activity migrates to Hong Kong. However, Hong Kong may face a big disadvantage, which is a less active and liquid market. Based on the total turnover ranking among top global exchanges consolidated by Bloomberg data, New York Stock Exchange in 2021 has $28 trillion of turnover, which is about 6 times higher than Hong Kong Stock Exchange. There is still a huge gap for Hong Kong Stock Exchange to catch up in terms of liquidity. All in all, current Hong Kong and the China markets are still under pressure by weak market sentiment, large-scale lockdown in terms of worsening COVID outbreak in some of the mainland cities. However, Hong Kong still stands to gain from a shift in US listed Chinese companies to the city and the mutual market access program with mainland China. We are expecting the Hong Kong Stock Exchange is poised to increase turnover, and ADR conversion to Hong Kong shares could also pick up. So it comes to the end of my portion, and thank you for your attention, and I will pass the time to Ying for technical analysis.
Okay, thank you, Zihan, for the wonderful sharing. Okay, I'm Ying here. I will be going through the technical analysis portion for this webinar. Okay, so basically the flow, I will just go through a few of these Chinese companies listed on the US stock exchange. Okay, then also going through a few of the Q&As if you have any. All right, I will be drawing the chart live, so I'll probably go through maybe 2 to 3 of it. Okay, then I will end off my session and pass it back to them for the Q&A. Okay, so this first chart that I'm going to share is on Alibaba. Okay, Alibaba listed on the New York Stock Exchange. Okay, Alibaba has been coming down on a downtrend for probably 1.5 years now. Okay, the downtrend unfortunately is still going to continue. Okay, as you can see, we have a break of structure causing a bearish market structure as of now. We have a new recent lower high that is formed from the recent out move that they tried moving above the $110 level. Okay, subsequently, this minor range itself has been broken. Price has been coming down quite steadily towards a $82 level. Okay, however, I mean, this downtrend is probably just going to continue back towards a 75 range to see if there's any strong rebound off as what happened previously. Okay, but considering how all the major indices in the US has been coming down as well in recent weeks, we still have to see how the major markets are actually moving before we can determine what the counter itself might be moving towards. Okay, the next chart will be on JD. Okay, JD very similar to Baba as well. Okay, they are coming down from the high of $107. Okay, forming a very, I mean, it's quite a long-term kind of range at 83 towards $63. Okay, $63, $65. This range has been ongoing for 1.5 years until recent months they broke down. Okay, forming a very bearish market structure with recent highs coming back towards $65, and they failed to continue the up move. All right, so with this lower high being formed, confirming a supply level at this level of 63 to 64 level. Okay, the downtrend is the same, okay, as Baba. It will probably be continuing, and also in recent weeks itself, they broke off from a minor demand level. Okay, we have a gap area to be filled as well. Okay, price is probably coming back towards 46.5. Anything lower will be heading towards a 37.4 level. Okay, then the last one I have for you will be Baidu. Okay, it's the same as well. Okay, it's on the downtrend, breaking away from range as well. Okay, so recent weeks steadily coming downwards. Okay, covering the previous gap up movement. Okay, after bouncing off from 102 level. Okay, price is currently coming back to this level. Okay, but unless we are looking at a very strong rebound off with a bullish closure, right? Structure wise, it's not signaling on any like bullish movement yet. Okay, but however, we are reaching a delicate level. We might be seeing some sort of rebound moving back towards a 138 level. Okay, then we probably see another form of rejection shown. Then you will probably have a range being formed in this area. All right. Okay. Okay. With that, right, okay, because for now I don't see any counters that you need me to draw. Okay, I will just go through S&P, and the last one will be Nasdaq. Okay. Okay, S&P. Okay, I think I explained this on Monday during the live counter review webinar. Okay. Market, I mean the major indexes, right, for Dow Jones, S&P, and Nasdaq itself, they have been very bearish in the last 3 weeks. Okay, so now today we are heading towards the mid of the week. Okay, market has been moving very bearishly the past 2 days. Okay, so it's the same. I mean, we will be expecting it to come towards a 4,100 level. Okay, any break of this structure itself, we might see a short-term rebound off towards a 4,200. With that level not being able to hold above, we'll see it be coming down very steadily towards a 3,900, 4,000 level. Okay, then the last one before I end off my technical analysis will be on Nasdaq itself. Okay, the index, same thing this week. They tried forming a small retrace yesterday. The day before. Okay, then subsequently the movement itself has been coming down bearishly towards this delicate level. But with this movement downwards, right, they actually broke the structure. Okay, forming a bearish market structure, moving price towards a 12,500 level. Okay, so as of now, we don't see any rebound of any bullish sentiments yet. Okay, so for now, there's nothing much to really be optimistic about yet. Then this week we will have very heavy tech giant data, so the earnings release. So please take note of that. Okay, then okay, since quite a few have been asking, I will do the last one, which will be C Limited. Okay, it's not related to Chinese ADR, but C Limited. Okay, same thing. I think I've been talking about C for quite a while now. Bearish market structure with this break yesterday. Okay, with this movement, downtrend is still going to continue. You have a lower low, you have a recent lower high. Okay, with this new lower low, you might be seeing some sort of short-term rebound towards 100 and 205 level. Okay, but with that being said, right, this downtrend is probably still going to continue. Okay, there's no signal of any, same thing, the reversal is not coming in yet. Okay, the lowest level, the next level, it might be going towards, and the downside is towards the 74.1 area. Okay, then with this, I will end off the TA portion. Okay, feel free to join the Telegram channel for Podium's TA. We have weekly webinar on live counter review, okay, for US market and also Asian markets. So yeah, I'll catch everyone there. Okay, then with that, I'll pass the time to Darren to go through a few promotions. All right, thank you everyone for your time.
Thank you, Ying. I would now like to just give our speakers a short break before we carry on with our short Q&A session. So we have an official Global Markets Desk Telegram channel. Next slide, please. Basically, we have economic, we have the eco calendar on, we have our Phillip morning note, we have market summaries, all daily news available over there. You can scan the QR code to join. Alternatively, you can just click the link in the chat if you're on mobile. So so if you have enjoyed Ying's technical analysis session earlier, we do also have the Poyam's technical analysis channel, where basically you can input your counters inside. And every Monday he has a webinar. The links and the links to join the webinar will be sent in that Telegram channel. So we highly recommend these two channels for you to join. It will greatly benefit your investing journey, and it also gives us an opportunity to give you more. So now, moving on, please feel free to contact anytime. We cater to Chinese clients as well as Japanese clients. They will be able to answer all your questions pertaining to accounts, fees, and even assist you in opening an account. You just need to call in or drop us an email, and we will definitely give you a call back. So now, after our speakers have had a short break, we do have a few minutes for our Q&A session. So now we'll move on to the Q&A session. So Chester, unfortunately, due to our time constraint, I will just answer the first few questions. Chester, are you okay with that?
Yeah, sure, no problem.
Okay, I think one of the questions that a lot of people have been wondering at the start of the presentation is, are there any arbitrage opportunities?
Okay, so yeah, are there any arbitraging opportunities from the ADRs and the home exchange, I assume? So yeah, as mentioned previously, the prices are actually tracked closely to the home exchange. So this is done to promote efficiency and also to reduce arbitraging. But then again, even if there is this possibility of any arbitraging chance, right, the profit should be relatively low, and it will most likely be eroded by trading related fees. Yep.
Thank you, Chester. On to the next question. How do we convert ADR to ordinary shares of home exchange?
Okay, yeah. So I think the clients must be thinking, they have ADRs and they want to change it back to the home exchange, maybe in case gets delisted or something else. So yeah, what they can do, right? For clients of Phillip, they can actually just contact their trading rep, for this request. And the trading team, they will just proceed on with the whole backend process of transferring your share from the ADR towards converting your ADRs towards the ordinary shares of the home exchange. But also, right, you gotta take note that this conversion actually do come with additional fees. And yeah, for more information, you can just simply just check with your trading team. Yes.
Okay, are there any additional fees that will come with trading ADRs?
Additional fees that comes with trading of ADRs. So yeah, apart from your usual brokerage commission, for example, yeah, you need to note that there will be additional fees when it comes to trading these ADRs, commonly known as the ADR fee. And this ADR fee actually they do vary from every ADR, and this fee is normally determined by the depository bank that actually issues this ADR.
Thank you, Chester. Maybe just two more questions. What happens to our shares when a company will delist?
Okay, yeah, that's actually a very good question. So, so what will happen when you own the ADR maybe, and then the company gets delisted, right? So we are looking at maybe three possible scenarios that might happen in the event of a delisting. So the first scenario, a share buyback. Second scenario, shares transfer. Or the third scenario, your shares could be in a limbo. Okay, so for the first scenario, in the event of a shares buyback, the company will purchase shares back from the investors at an agreed upon price, effectively, taking this company private. They may then choose to list on a second exchange, another exchange. Okay, for the second scenario, the shares transfer. So like mentioned just now, the whole ADR conversion back to ordinary shares. So this is that situation, shares transfer. So investors can swap out their ADRs for foreign company shares and resume trading on the home exchange of that company. And for the third scenario, where your shares could possibly be in a limbo, investors would still be holding on to those shares, but those shares will not be able to be traded over a regulated exchange. So some options, if you want to trade it, right, maybe you can, if it permits, maybe that counter ends up trading on the OTC markets, or investors could just hold on to it until a suitable listing occurs. So yes, we're looking at these three possible scenarios.
Thank you, Chester. Thank you, everyone, for coming. Unfortunately, we have had to end the session right here. Chester, maybe you'd like to wrap up the session?
Yes, sure. Okay, yes, guys. Yeah, thank you for your time so far. We have reached the end of this webinar for today. Yeah, we do apologize if we are not able to answer all questions in the Q&A, but always feel free to drop us any questions at these two emails. We will do our best to answer all your queries. And also would remind you guys again, would appreciate if you could spare a few minutes of your time to fill out this feedback form by scanning the QR code or clicking the link for the feedback form provided in the chat. Thank you once again, guys, and good night.
Thank you, everyone, for attending our monthly webinar. We hope to see you again next month. We will leave the feedback form up for a while more, but we have come to the end of the webinar. Thank you and good night.